All right, let's dive in today, shall we? We're going deep into the world of mineral rights, specifically a company called Dorchester Minerals. We've got a mountain of SEC filings, presentations, even some contract bits and pieces.
Yeah.
And our mission today is to unearth how Dorchester operates, the risks they face, and maybe even uncover some, well, some fun facts about mineral rights along the way.
Sounds good. I think what's really interesting about Dorchester is they're not your typical oil and gas company. They don't actually drill or pump any oil themselves.
hmm
They've built this whole business around owning the rights to the minerals beneath the land.
So are they like the landlord in a gold rush town,
Yeah.
just collecting rent no matter who strikes it rich?
Yeah, you could say that. It's a good analogy. They
Mm.
let other companies, the operators, handle the messy work of getting that oil out of the ground.
hmm
And Dorchester just sits back and collects a share of the profits.
Clever, but their filings do mention a few potential hiccups, right? Fluctuating oil and gas prices, wells running dry, environmental regulations. They even sold off that net profits interest, the Hugoton sale, wasn't it? For $5.7 million back in 2020.
Yeah, the Hugoton sale. Yeah, that's an interesting one. Makes you wonder if maybe Dorchester is shifting their focus a bit, moving away from those mature fields like Hugoton.
hmm
It could be a sign they're anticipating a decline in production in that region, you know?
So they're not just sitting on these rights, they're actively managing their portfolio.
Yeah.
Buying, selling, developing, kind of like a high-stakes game of Monopoly, but with real oil wells.
Yeah, exactly. It's not just about owning the land, it's about knowing when to hold them and knowing when to fold them.
Now, the filings also reveal some interesting details about Dorchester's governance structure, specifically the role of their general partner.
Right.
So, what's the deal with the general partner? Why should our listeners care about this?
Well, the general partner essentially runs the show at Dorchester. They make the key decisions about acquisitions, development, even how the profits get distributed.
Yeah.
And here's the thing. They receive a fixed 4% of the net cash generated,
Regardless of...
regardless of how well Dorchester actually performs.
So even if Dorchester has a bad year, the general partner still gets their cut. Doesn't seem very fair to the unit holders, does it?
It's definitely a point of contention for some investors. Critics argue that this fixed fee structure, it could incentivize the general partner to prioritize growth over profitability, potentially leading to acquisitions that, benefit them more than the unit holders.
It's a reminder that due diligence isn't just about analyzing numbers. It's about understanding the people behind those numbers.
Couldn't agree more.
The filings also mention this interesting detail about Dorchester being considered a passive entity for Texas margin tax purposes.
Mm-hmm.
What's the significance of that? Does that mean they're dodging taxes?
No, not at all. It just means that the unit holders, the investors, they're the ones responsible for including their portion of the revenue in their Texas margin tax calculations. It's a nuance, but it could impact an investor's overall tax liability, especially if they're based in Texas.
Yeah, so it's not just about the potential profits.
Yeah.
It's about understanding those tax implications.
Right.
It's like finding out your dream vacation home comes with a hefty property tax bill.
Exactly. Then there's the whole issue of UBTI, unrelated business taxable income.
UBTI. Sounds like a headache.
Yeah. Well, even though Dorchester is considered a passive investment, certain activities can generate UBTI, and this could make a portion of those earnings taxable, even if an investor is normally exempt. It's a niche thing, but worth knowing about.
So it's like a hidden trapdoor in the world of mineral rights.
Yeah.
You think you're safe, but then bam, hit with an unexpected tax bill.
You got it. And what's really interesting is that Dorchester acknowledges the possibility of realizing UBTI in an effort to maximize unit holder value.
Okay.
But it really highlights that tension between trying to maximize those profits and catering to those specific tax needs of certain investors.
Definitely a balancing act.
Now, one thing that's important to understand about Dorchester's financials is their use of the full cost method of accounting.
Okay, pop quiz time. What is the full cost method of accounting? And why should anyone care?
Well, the full cost method, it's basically a way of accounting for oil and gas exploration costs.
Mm-hmm.
You can think of it like every time they drill a well, it's like swinging a bat. Some hits are home runs, some are strikeouts.
Okay.
But the full cost method, it kind of averages out the cost of all those swings, regardless of whether they hit a home run or strikeout.
So it smooths out the bumps, but it also makes it harder to tell which wells are the real winners.
Exactly. It gives you a broader perspective, but it can obscure some of those finer details. It's something to keep in mind when you're looking at those financial statements.
Makes sense. You don't want to be fooled by a batting average that's inflated by a bunch of bunts.
Precisely. Now, Speaking of Dorchester's assets, they've got a lot of undeveloped properties, and that's where things get really interesting.
Okay, tell me more. What's their strategy with these undeveloped properties?
Well, they see these properties, the ones with known mineral resources but no active production yet, as a major growth opportunity. They're essentially betting on the future of oil and gas prices.
So they're buying land hoping it'll become a bustling city one day, except instead of skyscrapers, it's oil derricks.
Yeah, that's a great analogy. The risk, of course, is that those hopes might not materialize, either because oil and gas prices stay low or development costs prove to be too high.
It's a speculative play for sure.
Absolutely. And there's also the fact that unit holders, they don't really get a say in those acquisitions. It's a lot of trust placed in the general partner's hands.
Yeah, that does seem like a lot of trust. What kind of risks does that create?
Well, it all boils down to that classic principal agent problem, right? The general partner's interests might not always align perfectly with the unit holders.
Right.
So there's that risk that the general partner might prioritize acquisitions that benefit them, perhaps more than the unit holders.
Mm.
Investors really need to scrutinize those relationships and look for those potential red flags.
Now, let's talk about risk in general. Dorchester's filings highlight some specific risks they face.
Right.
What were some of the key ones that jumped out at you?
Well, the most obvious one is the inherent volatility of oil and gas prices, right? Their revenues are directly tied to the prices of these commodities, which can swing wildly based on global events, economic trends.
It's not a market for the faint of heart.
No, not at all. And then there's depletion. Oil and gas wells, they don't last forever. Production inevitably declines over time.
So you can't just sit back and collect those royalty checks forever.
Exactly. And then, of course, there are always operational risks to consider, like drilling accidents, equipment failures, even natural disasters. These things can disrupt production, drive up costs,
Right.
damage their reputation.
It's a good reminder that even a passive investment like mineral rights can be exposed to some pretty unexpected events.
Yeah.
What about environmental regulations? We talked about ESG earlier, but what specific regulations could impact Dorchester's operations?
Well, one example is the increasing scrutiny of fracking. Some states have imposed restrictions or even outright bans due to environmental concerns.
Right.
And these restrictions can limit Dorchester's ability to develop their properties.
And what about the big one, climate change? How's that impacting Dorchester and the broader oil and gas industry?
Well, climate change is a game changer. There's no doubt about that. The global push towards decarbonization is driving demand for renewable energy, while stricter environmental regulations are increasing the costs for those fossil fuel companies.
So it's not just about the price of oil and gas. It's about the changing landscape of energy production and consumption.
Yeah,
The ground is shifting beneath their feet.
exactly. Investors really need to consider the long-term viability of oil and gas investments in a world that's increasingly focused on sustainability.
Let's rewind a bit and talk about that Hugoton sale again. What does that tell us about Dorchester's overall strategy?
Well, the Hugoton sale, where they sold off a net profits interest in a property for $5.7 million, suggests they're willing to strategically sell assets, even if it means giving up a portion of future profits. It could indicate a shift in focus, perhaps moving away from those mature fields.
So it's not just about acquiring more. It's about optimizing their existing portfolio, knowing when to hold them and knowing when to fold them, as you said.
Exactly. They're constantly evaluating their assets, considering commodity prices, regulatory changes, their own financial needs.
It's a reminder that managing a portfolio of mineral rights is an active process. It's not a passive investment at all.
It certainly isn't.
Now, let's talk about that general partner's compensation again. We saw in the filings that they receive a fixed percentage of Dorchester Minerals' net cash.
Right.
So how does that work in practice, and what are the implications for unit holders?
Well, they get a fixed 4% of the net cash, regardless of how Dorchester performs. And as we said, the structure has raised concerns because their compensation isn't directly tied to those unit holders' returns.
So even if Dorchester has a bad year, the general partner still pockets their 4%.
That's right. And critics argue that this can incentivize them to prioritize growth over profitability.
It's like paying your real estate agent a flat fee regardless of whether they get you a good deal.
Yeah, that's a good way to put it.
How does Dorchester defend this structure?
Well, they argue that this fixed fee provides stability and predictability, allowing them to focus on long-term value creation. They also point out that the general partner bears the risk of any operating losses, which does align their interests with the unit holders to some extent.
So it's a balancing act,
Right.
right? Weighing the potential for those conflicts of interest against the need for stable management.
Absolutely.
Okay, before we wrap up this part of our deep dive, let's zoom in on 2021. The filings have some interesting financial and operational highlights from that year. What stood out to you?
Well, one key highlight was the acquisition of assets in exchange for units. Dorchester issued units worth over $43 million to acquire new mineral rights. So they're clearly putting their money where their mouth is when it comes to expansion.
They're not just sitting back, they're actively seeking out those new properties.
Exactly.
And on the distribution front, they paid out $1.53 per unit to those unit holders.
Yep.
So they're rewarding those investors.
They are. It's a delicate balancing act, but they seem to be managing it.
And their net income for 2021 was pretty impressive, over $70 million.
Right.
So it seems like 2021 was a pretty good year for Dorchester. They were growing, they were profitable, and they were keeping those investors happy.
It seems that way, but remember there are always those risks to consider. And those risks are constantly evolving, especially with that ongoing energy transition.
Absolutely. We'll delve deeper into that next time when we examine their governance structure and untangle that web of relationships and potential conflicts of interest.
Sounds good.
You won't want to miss it.
Welcome back to our deep dive into Dorchester Minerals.
Last time we really dug into their business model, explored those risks and rewards, and we even uncovered some hidden tax traps for those unwary investors out there.
Yeah, those are always fun.
And we're going behind the scenes, right? We're going to examine Dorchester's governance structure.
Exactly.
Get ready to untangle that web of relationships and power dynamics.
All right, so at the top, you have the Board of Managers, a group of 8 individuals responsible for overseeing the company.
8? That's a pretty big board. Are they all oil barons with handlebar mustaches, smoking cigars, and plotting their next big deal?
Not quite, no. But the way they're appointed is pretty interesting.
Okay.
5 of them are chosen directly by the members of the general partner of Dorchester Minerals general partner.
Hold on. You lost me there. It's like a corporate version of those Russian nesting dolls.
It is a bit layered, yeah. Essentially, Dorchester Minerals general partner is itself a limited partnership. And the members of that partnership, they have the power to appoint a majority of the board of managers.
So there's a concentration of power at the very top.
You could say that.
Do the unit holders, the everyday investors, does they have any say in who runs the show?
Well, the remaining 3 managers, they're nominated by those same members, but they are elected annually by the limited partners, the unit holders.
So there's at least a semblance of democracy going on here.
Yeah, but those 3 elected managers, they have to meet specific requirements.
Okay.
Including things related to audit committee membership.
Right.
This ensures a certain level of financial expertise on the board, but it also limits the pool of potential candidates.
It sounds like a system designed to balance control with accountability, but also one that could be swayed by those with the most power, right?
That's the big question. And this is where the potential for conflicts of interest really comes into play, especially given all the overlapping roles and relationships we've already talked about.
Right. We saw how personnel from the general partner are also involved with Dorchester Minerals. Does this interconnectedness extend to the board level as well?
It does. One board member, Alan Lassiter, he's got a long history in the oil and gas industry.
Oh.
He was actually the vice chairman of investment banking at Raymond James and Associates.
So he brings a lot of experience to the table.
He does. But he also currently holds a management position in another oil and gas company. So it raises those questions about divided loyalties, Are his decisions always putting Dorchester Minerals and its unit holders first?
It's a good reminder that governance isn't just about having the right qualifications. It's about making sure those individuals are truly acting independently.
Absolutely.
Now, in addition to the board of managers, Dorchester also has an advisory committee.
Right.
Another layer to the onion.
Yeah.
What do these mystery advisors do?
Well, they've got a variety of responsibilities.
Yeah.
But one of the key ones is approving compensation for employees who are also board members.
So they're like the salary police, making sure no one's getting an undeserved golden parachute.
Yeah, you could say that. They also weigh in on big decisions like acquisitions and divestitures.
So they have a pretty significant influence over Dorchester's direction.
They do.
Who are these shadowy figures pulling the strings?
Well, the advisory committee consists of Alan Lassiter, who we just mentioned, Ronald Trout, and C.W. Russell.
Okay, fill me in. What's the deal with Trout and Russell? Are they industry veterans, newcomers? What are we looking at here?
Well, Ronald Trout, he's a chartered financial analyst with a long career in investment management.
Got it.
C.W. Russell's background is a bit more, well, it's a bit more elusive.
Okay.
The filings don't really reveal much about his experience.
So he's like the silent partner, the enigma wrapped in a riddle inside a corporate boardroom.
Yeah, it does make you wonder what he brings to the table and why there's such a lack of transparency about his background.
Maybe he's a former secret agent. But anyway, it's clear that this advisory committee plays a big role in Dorchester's governance.
Oh, absolutely.
And understanding their motivations is crucial for investors.
It is.
Now, let's circle back to those potential conflicts of interest.
Okay.
There seem to be quite a few red flags waving here.
Yeah, that interconnectedness between the general partner and Dorchester Minerals is definitely a concern.
It seems like the general partner might be tempted to prioritize their own interests over Dorchester Minerals and its unit holders.
It's a possibility, yeah. For example, with acquisitions, the general partner might push for Dorchester to buy properties that are beneficial to the general partner's other businesses.
Even if those acquisitions aren't in the best interest of Dorchester Minerals.
Right. Or they might steer Dorchester towards developing properties that align with their own overall strategy.
So Dorchester could end up being used as a pawn
Yeah.
in the general partner's larger game.
It's a risk that investors need to be aware of.
So we've established that there's a potential for conflicts of interest. Does Dorchester have any safeguards in place to mitigate these risks?
Well, they do have some mechanisms like the advisory committee's oversight role and the requirement for independent evaluations of certain transactions.
So there are at least some checks and balances.
Yeah, but as with any system, it's not foolproof. It really comes down to trust. Unit holders need to assess whether they believe the general partner will act ethically.
It's a judgment call each investor has to make.
It is.
Now let's shift gears a bit and explore Dorchester's plans for the future. How are they looking to expand their mineral rights empire?
Well, their primary focus is on acquisitions.
Okay.
They're actively seeking to acquire more mineral rights, both in their current areas and in new territories.
They're expanding their footprint.
Exactly. They're targeting properties with proven oil and gas reserves, and also those with potential for future development.
It's like a high-stakes treasure hunt.
It is. Now, one of their key acquisition targets is those undeveloped properties, the ones with known mineral resources but no active production yet.
Right, we touched on those earlier. They seem a bit risky, betting on the future potential of those properties.
They are. Dorchester believes they can unlock the value of these properties through their expertise, their relationships with operators.
So they're saying they can do a better job of developing these properties than the current owners.
That's the idea, but of course it comes with risk. Actual reserves might be lower than estimated. Development costs could exceed projections.
Right.
Oil and gas prices might not justify production.
It's a high-risk, high-reward kind of strategy.
It is. Due diligence is crucial here.
You mentioned that Dorchester is also expanding into new areas. Do the filings reveal any specifics about where they're looking?
They don't get into specifics, no, but they mention a focus on areas with favorable geology and attractive economics.
So they're looking for the sweet spot, where the geology is promising, the regulations are favorable, and the profit potential is high.
Exactly. They're also considering things like infrastructure availability, the presence of experienced operators.
They're taking a measured approach.
They are.
Yeah.
Finding the right acquisition targets is a complex process.
It's not just about buying any old patch of land that might have oil underneath.
Right.
It's about making those strategic acquisitions.
Absolutely.
Now, in addition to those acquisitions, Dorchester is also focused on developing their existing properties.
That's right.
They're working with operators to optimize those drilling techniques, improve well performance, extend the life of those existing wells.
Exactly.
So they're not just relying on acquiring new property.
They're trying to get the most out of what they already have. It's about maximizing the value of those existing assets.
That sounds like a solid strategy.
Which it does.
But one that requires a lot of expertise and careful execution.
Absolutely.
Now, let's dive into a topic that's becoming increasingly important for investors: ESG, environmental, social, and governance. We've touched on it throughout our deep dive, but it's worth exploring in more detail, especially with all the scrutiny on the oil and gas industry.
Yeah, absolutely. ESG factors are no longer just a niche concern. They're becoming mainstream.
So it's not just about profits anymore, right? It's about how those profits are made and their impact on the planet and society.
Exactly. Investors are looking at companies' environmental footprint, their social responsibility, their governance practices.
So how does Dorchester measure up in these areas? Are they leading the charge, lagging behind? Where do they stand?
Well, the answer is it's a bit nuanced. Their filings give us some insights, but they also leave some gaps.
Okay.
It's hard to tell how deep their commitment to these ESG principles really is.
Let's start with the E, environmental impact.
Okay.
What are their key environmental risks, and how are they addressing them?
Well, their biggest environmental risk is climate change. There's no doubt about that.
Right.
As the world transitions to a lower carbon economy, demand for oil and gas is likely to decline, and that could have a big impact on Dorchester's revenues in the long run.
It's a long-term threat.
It is. And Dorchester does acknowledge this risk in their filings.
Okay.
They say that climate change and related regulations may adversely affect demand for oil and natural gas, which could hurt their business.
So they're aware of the challenge.
They are. But how are they responding to this pressure? Are they taking concrete steps to reduce their environmental impact?
Are they just talking the talk, or are they walking the walk?
Well, they do say they're committed to responsible operations, including minimizing those environmental impacts, but the specifics are a bit vague.
It sounds like they're dipping their toes in the water of ESG, but they haven't fully jumped in yet.
Yeah, that's one way to put it. They could be doing more behind the scenes, but without more transparency, it's hard to assess their commitment.
It's a bit of a yellow flag for investors who care about ESG.
It is.
Now, let's move on to the S, social responsibility. How does Dorchester approach its relationships with stakeholders, employees, communities, landowners?
Well, it's complicated because they don't actually operate those oil and gas wells.
Right.
They're essentially a landlord.
So their social impact is a bit more indirect.
It is, but they still have a responsibility to make sure those operations are conducted in a socially responsible manner.
What are some of the specific social risks associated with their business? Are we talking oil spills, protests, or something else?
One key risk is that potential for disruption and environmental damage caused by that oil and gas development.
Right. Drilling operations can be noisy, disruptive, and those accidents can have devastating consequences.
Exactly. And Dorchester does acknowledge these risks. They say that operations on their properties may result in environmental incidents that could affect the environment or nearby communities.
So they're aware of the potential downside.
They are.
But what are they doing to mitigate those risks?
Well, they emphasize working with reputable operators who have strong environmental and safety records.
So it's about choosing the right partners.
Right.
They also mention having contractual provisions to address environmental matters. But again, they don't get into specifics.
Yeah, more transparency about those provisions and how they're enforced would be helpful.
It's another yellow flag for those investors who are focused on social responsibility.
It is.
Now, the G, corporate governance.
Okay.
We've already dissected their governance structure.
Right.
Are there any specific governance risks that stand out from an ESG perspective?
Well, one potential concern is the lack of board diversity.
Right. The board of managers is entirely composed of white men.
It is. And studies have shown that diverse boards tend to make better decisions. A lack of diversity can be a sign that a company isn't really embracing those best practices in corporate governance.
Like an echo chamber, right. Everyone comes from the same background, shares the same perspective.
Exactly.
And Dorchester's filings don't address board diversity directly.
They don't.
It's a question worth asking.
It is.
Another potential risk is that concentration of power in the hands of the general partner.
Right.
It can create conflicts of interest, as we've seen, and it can limit the accountability of the general partner to those unit holders.
It's like a system with too much power at the top, with very few checks and balances.
Exactly.
Now, before we wrap up ESG, it's worth noting that Dorchester does have a code of conduct and ethics.
Okay.
They say it applies to all their officers, employees, and directors, but again, no real details about its content or how it's enforced.
More transparency would be helpful.
It would.
Investors need to know what those ethical principles are and how the company makes sure everyone's following them.
They do.
Now, having explored Dorchester's governance, their growth strategies, their approach to ESG, Let's step back and consider the bigger picture.
Mm.
What are their long-term prospects in a world that's moving away from fossil fuels?
Yeah, that's the million-dollar question, isn't it?
Their entire business model is built on the extraction of oil and gas.
And the energy landscape is changing. There's no doubt about that.
Right, renewable energy is becoming more competitive, and governments are pushing for decarbonization.
Exactly.
It's a trend that's not going away.
It isn't. So where does Dorchester fit into this new paradigm? Can a company built on oil and gas really thrive in a world focused on sustainability?
That's the challenge they face. If demand for oil and gas declines, their revenues are going to suffer.
They are, and Dorchester acknowledges this. They say that the increasing focus on renewable energy and government regulations could adversely affect demand for oil and natural gas.
So they understand the headwinds they're facing,
They do.
but it's also an opportunity for them to adapt, right?
It is. They could diversify their portfolio, maybe invest in renewable energy projects.
It would be a big shift in strategy.
It would, but it might be necessary for their long-term survival.
It's a reminder that even companies built on seemingly unshakable foundations need to be prepared to change,
Absolutely.
adapt to those new realities.
This energy transition is creating both challenges and opportunities.
It's a story that's still being written, isn't it?
It is.
Will they be the protagonists of a success story? Or will they become a cautionary tale?
Only time will tell.
It's all part of the deep dive, right? Exploring not just the present, but the potential future.
Exactly.
Now, let's move on to another crucial aspect, their financials.
Okay.
We'll dig into their revenue, profitability, debt levels, and see what it all means for their future prospects.
Sounds good.
Join us for part 3, where we'll crunch those numbers and see if Dorchester Minerals can weather the storms ahead. All right, welcome back to the deep dive.
Glad to be here.
We've gone through a lot with Dorchester Minerals, haven't we? Their business model, that governance structure, their ESG approach.
Yeah, we've really dug deep.
We've seen those strengths, the weaknesses, those challenges they're up against in this ever-changing world.
Absolutely.
Now, it's time for the financial checkup. We're going to look under the hood and examine those financials. We're talking revenue, profitability, debt levels, trying to get that clear picture of their financial health.
Exactly. Like looking at those vital signs to see if the company's thriving or barely hanging on.
Let's start with revenue, the lifeblood of any business. How's Dorchester been doing on that front?
Well, the revenue is mainly tied to oil and gas production, right? So it's been a bit of a roller coaster following those commodity prices.
Mm-hmm.
But, despite those ups and downs, they've been able to bring in substantial revenue even when the market's been volatile.
Okay, well, give me some specifics. What kind of numbers are we talking about?
Sure. In 2021, their total revenue was over $142 million. And even in the first quarter of 2024, they pulled in over $80 million.
Not bad at all. But revenue is only part of the story. We got to profitability. Are they turning those revenues into actual profit?
Oh, they're definitely making a profit. In 2021, their net income was over $70 million.
That's pretty impressive. What's driving that? Is it just those high oil and gas prices, or is there something else going on?
It's a bit of both, actually. Favorable commodity prices definitely help. But remember, Dorchester's got a pretty low-cost structure because they're not handling that actual drilling and production themselves.
Right. They're the landlord collecting rent without having to deal with those day-to-day expenses.
Exactly. And that lets them maintain those healthy profit margins even when those commodity prices aren't, sky high.
That's good news for those investors, right? It means they can weather those inevitable market dips.
Yeah, it does.
But as we've talked about future profitability, that depends on a lot of things. Oil and gas prices, their ability to execute that growth strategy.
It all ties back into those big questions we've been exploring.
Yeah, we've got to talk about those distributions per unit, that cash flow that goes back to the unit holders.
Mm-hmm.
Big deal for those income-seeking investors.
Absolutely. It's a major factor for them.
So how are those distributions looking? Are they being generous with those investors?
They've got a pretty solid track record of paying out those distributions over the years.
Okay.
In 2021, it was $1.53 per unit. And in the first quarter of 24, it was $97.
So there's some fluctuation, but overall, those are pretty decent payouts, especially for an industry like oil and gas.
Yeah, they're not bad at all.
But, the big question, can they keep those distributions coming?
Right. That all depends on their cash flow if those profits start drying up.
Yeah, those distributions could shrink too.
Now, let's talk about something that always makes investors nervous. Debt. How much debt does Dorchester have?
Yeah, we got to know that,
Yeah.
especially in an industry like this where those revenues can really go up and down.
Well, the good news is their debt levels are pretty low. They've managed their finances well and haven't, gone crazy with borrowing.
So no risky financial games going on here.
No, they seem to understand that a strong balance sheet is essential in an industry like this.
That's reassuring for investors, right?
It is. It means they're not overextended
Yeah.
and vulnerable if the market takes a turn.
But their partnership agreement, it does put some limits on how much debt they can take on, right?
It does, yeah. There are certain thresholds they can't exceed.
So what kind of limits are we talking about?
Well, they can't take on debt that would push them past those thresholds.
Okay.
Plus, they've got to be mindful of their tax status. Too much debt, and they could lose some of those favorable tax treatments.
So it's a balancing act, right? They need that capital to grow, but they can't go overboard.
Exactly. They've got to walk that tightrope carefully.
All right, so we've looked at revenue, profitability, debt levels. Overall, how would you describe Dorchester's financial health?
Well, based on what we've seen, they seem to be in a pretty strong position.
Okay.
Good revenue, consistent profits, decent distributions, and manageable debt. All good signs for a company in this industry,
But of course, their future depends on a lot of factors outside their control.
right? Like those oil and gas prices and how fast that energy transition
Those
happens.
are the big unknowns.
They are.
Well, we've covered a lot of ground with Dorchester Minerals, haven't we? Their business model, governance, growth strategies, ESG, those financials.
Yeah, we've been through it all.
So what are the key takeaways here? What should our listeners remember from our deep dive into Dorchester?
Well, I think the biggest takeaway is that Dorchester is a unique company operating in a niche but potentially very profitable market. Those mineral rights,
Right.
they figured out how to profit from oil and gas without actually getting involved in the extraction process.
They're the landlord.
Exactly. And that
Uh,
business model, it's fairly low cost, which allows them to generate those healthy profits and those consistent distributions.
But as we've said, their future is tied to that oil and gas industry.
Yeah.
And that industry is facing some major challenges.
Right. Climate change, renewable energy, that pressure to transition to a more sustainable energy future.
Their growth strategy, it's ambitious, but it relies on the demand for fossil fuels staying strong.
And that's a big question mark going forward.
It is.
We also saw that their governance structure, well, it raises some concerns about those potential conflicts of interest.
The general partner's influence, the lack of transparency.
Exactly. And while they are addressing ESG considerations, there's definitely room for improvement.
So what does this all mean for those potential investors out there, those who are considering Dorchester Minerals?
Well, it means investing in Dorchester is not without risk. There's potential for growth and income, but those risks need to be, carefully considered.
Investors need to really think about their own risk tolerance, their goals, their time horizon.
Right. Are they in it for the short term, or are they willing to ride out the ups and downs for that long-term value?
They also need to look closely at Dorchester's management team, their track record, their ability to adapt in this changing world.
Can a company that's built on oil and gas succeed in a world that's moving away from fossil fuels? That's the big question.
And there's no easy answer.
No, there isn't. Each investor needs to grapple with these questions and come to their own conclusions.
That's what the deep dive is all about, right? Giving our listeners the information they need to make those informed decisions.
Exactly.
We have explored Dorchester Minerals inside and out, their strengths, their weaknesses, the challenges, the opportunities. Now it's up to you, the listeners, to decide if this investment is right for you.
We always encourage our listeners to do their own research, dig deeper, and reach their own conclusions.
The world of investing, it's constantly changing.
It is.
Knowledge is power, as they say.
Absolutely.
Keep learning, keep exploring, and keep diving deep with us.
That's it for this episode of The Deep Dive.
We'll see you next time.
Happy investing, everyone.